So are there alarm bells out there, or are there always some alarm bells out there? It's just we don't spot them. I think it's a little bit of both. I mean, you look at some areas of the market at the moment, and I'll draw your attention to the VIX as well, which has been quite useless, as we've read it, as a metaphor for some form of need for insurance in the market. It's now trading at 25. People getting a little bit nervous, and that has popped up in the last couple of sessions as well. You've got the bond yield. Now, you lot out there have been worried about the fiscal position of the United States and other sovereigns for a very long time, but now you're seeing bonds as a safe haven again. And then, as such, the 10 years just gone under 4% again, now around about 3.9 handle as well. So there's a couple of alarm bells out there. And what about your gold positions as well? Gold, despite everything else selling off today, still has a bid. Now, has that become a momentum trade, or is it still the right thing to do? We had a commentator in the last hour who was talking about that. But what are you actually worried about? And I think that's the question as well. Is it you're worried about lending standards? Are you worried about the banks? Are you worried about valuations? And herein lies the problem. I just showed you a load of defence stocks in Germany. And let's face it, no one is saying that the European powers will stop buying European defence stocks products over the next couple of years. But what perhaps you are saying is that the valuation support at the moment doesn't help. I.e., when you've got a defence stock trading at over 40 times forward, which, by the way, is more than what Nvidia trades at, just as a caveat, then you know that something's gone a long, long way. Whether it's gone too far, that's not my job to tell you. But European lenders definitely set for a day in the red after their regional US peers came under pressure Thursday. Go on, own up. How many of you have heard of Zions Bancorp on this side of the Atlantic? There's about 4 of you put your hand up. Most of you don't, do you? But look, after Zions Bancorp revealed it will face a sizable charge on bad loans. Western Alliance also alleged a borrower had committed fraud. Now, that sent the broader KBW, which you have heard of, Regional Banking Index, onto its worst day since April's tariff-induced slump. The warning comes amid a recent spate of high-profile bankruptcies from First Brands and Tricolor, and raises questions about the overall health of credit markets. And this is the point. Every time we get one of these, the bulls say it's just a one-off. The lending standards at that particular institution, it was a one-off. It was about one rogue client. It was about a lack of proper audit at one institution. But when you start seeing Western Alliance added to Zions, added to Tricolor, added to First Brands, does that start representing a pattern? Again, I don't know the answer. I'm just asking you the question. US lenders tapped, meanwhile, the Fed's standing repo facility for $15 billion over the last 2 days. Why does that matter? Because it's the largest amount over a 2-day period since the COVID-19 pandemic. Repo lending rates have pushed above the Fed's designated 4.25% this week, forcing dealers to use the Fed facility as an emergency source of liquidity. Now, the repo market, which, again, the man on the screen, Jay Powell, has dubbed, amongst others, the plumbing of the financial system, is often looked at as a key indicator of market liquidity. And if we're starting to worry about market liquidity, that's very interesting. We're not talking about Zions here or Western Alliance. We're talking about the broader banking sector. Let's take a look at the pre-open for the US banks, the big names. And here's the interesting thing. Every single one of those names you can see on the screen there, and I'll add Morgan Stanley to it, had great numbers. Let's be honest about it. Some you may well have met the whisper, but you may not have met the overall, or vice versa. The truth of the matter is they all had a terrific earnings season as well. But are we getting caveats and concerns from elsewhere? Because these banks, they've come a long way. Look at your price to book on them. A lot of people look at price to book rather than forward PE in the banking sector as well. They have come a very long way. In the meantime, Europe is selling off, and Ritika is going to talk us through it.
Yes, Steve, that sell-off in Europe getting worse. You can see there the Xetra DAX down more than 2%, the FTSE down 1.5%, the FTSE MIB also down some 2%. Really taking their cues from Asia, from the US, all these concerns about credit quality in the banking space. It's been a choppy week for European markets. Actually, when I came in this morning, it still looked like we were going to get some gains on the week. Now, clearly not. The only one I think that's still up on the week is the CAC 40. We know we had those big gains in the luxury sector. Let's take a look at the losers on the day. Well, clearly, it's all losing, all of the major sectors, but the ones that are getting hit the worst, I should say, banks, that's down 2.7%. again, coming over those with concerns over from the US on credit quality. So the likes of Barclays, Santander, Deutsche Bank, all getting hit, some about 5 or 6% or so. You can see that's followed by financial services, industrials and insurance. They're off 2%. Let's flip up the board and see how US futures are looking to trade this morning. And it looks also that we're adding to the losses there. The S&P minis down some 1.4%. The bigger question, of course, Steve, being whether these issues that we're seeing in the banking industry, whether there's something deeper, there's deeper cracks forming, whether this is systemic rather than just a one-off.